Hi, this is Sean Herndon with Winston Dane at Keller Williams here, Lake Norman, and today I'm with Matt Doyle from Guild Mortgage, and we're going to go over June's numbers and kind of go a little deep dive in here. So, Matt, if you could just kind of share with us what you're seeing from the mortgage side in the market.
Yeah, of course, and thank you for introducing me. So, first, I want to talk about what happened to get us right here in the market. So May 2021 to May 2022, the consumer price index increased by 8.6%. This was the largest 12-month increase since the period ending December 1981. Now, consumer prices for all items rose 6.5% throughout the entire of 2022. So December to December for 2022. As an effect, the average mortgage rate for a 30-year fixed rate ended 2022 at 7.12%, which was nearly doubled what it was at 3.22% beginning of the year. So long story short, consumer price index went up, interest rates followed. So here's where we are right now. CPI inflation came out today with the smallest annual increase in over 2 years. Came out at 3%. As of June, which was below the market's prediction of a 3.1%. As a result of this better than expected inflation report, both stock and bond prices are generally better this morning than where they were yesterday. Now, rising rents drove 70% of the CPI increase in June. So if you're currently renting, I wouldn't suggest waiting for a lease renewal because more than likely you're going to be paying more on that lease renewal than what you are right now. Now, Sean, the big takeaway here on the consumer CPI numbers is that inflation rates are continuing to decline and at a quicker rate than the markets had expected. Today's reports was positive for both stocks and bonds, but we do need to see a continuation of this trend line for the markets to get comfortable enough so the Fed can start to ease off their rate hikes. As of right now, there's an 88% probability that the Fed will do another rate increase in their upcoming meeting later this month. Now, if this trend continues and inflation continues to go down, I'm hoping that we will only see one more rate hike by the Fed this year. If that's the case, I think mortgage rates will trend lower starting in September and continue to decrease throughout the remainder of 2023 and 2024.
I'm hoping too. We are all hoping that this trend line is going to be going more decreasing, so it can give us more relief and helping for affordability and everything else that's in the market. And yes, very good news about the CPI. Still, it's positive, but a lot smaller, and it's been a long time. So hopefully with the effects of what the Fed is, it will continue down that line. To kind of give you guys a little bit more idea what's going on here also locally. So for like new listings in Cornelius, we were at 661. Now that's below, it's about 26% below than it was this time last year. In Mooresville, we're at 1,987. That's 24.2% lower than it was last year. Denver, 869. They were, now they're small areas, so they're going to trend a little lighter, but they were 7.7% lower. Sherrills Ford actually increased by almost 40% at 397. So new listings are really going off in the Sherrills Ford area compared to last year. In Huntersville, we're at 1,298, which is a decrease of 34%. Supply. Now, this is our monthly supply. Again, supply comes in as basically what the amount of homes that are on market, how fast they will be absorbed by the market if nothing else changes. So, for example, in Cornelius, we're still very strong sellers market at 1.6 months, which is an increase, which is crazy. It's an increase of almost 78% from last year. So we thought, inventory's tight now. It was super tight last year. Mooresville is at 2 months, which is an increase of 61%. Denver is 2.3 months at 63 increase. Sherrills Ford's 3.9 months, almost 4 months, an increase of 62% in Huntersville. Just as tight as actually the most tight out of everyone at 1.4 months of inventory, which is an increase of 55%. It's just crazy on how tight and low inventory we're in right now. And the biggest thing that we're running into is everyone's got phenomenal interest rates that they got last year or the last 2 years. So everyone's sitting on high 2s, low 3% mortgages. They're not really ready to trade up to go to 7%. But that's why Guild and has done a wonderful flexibility of helping with like buy downs and stuff like that. So if you are in those situations, you're ready to buy or sell, we definitely have some options for you so that you can have some flexibility when it comes to the interest rate. So on your closes, so basically overall, we're we're still a decline in closed units around the lake. And medium prices, we've been hearing more and more. Everyone's like, oh, prices, we're going down, we're going down. We are an increase, which is phenomenal. That's good. Now, the reason is because inventory is so low. And so it's good that we have low inventory. It's keeping us appreciating, not depreciating in the market. So just a quick rundown. In Cornelius, the medium prices are at $494. That's almost 14% increase from last year. So that's great for those, for that equity out there. Mooresville, we're at $450,000. That's an increase of 8.4. Denver, $471,000, which is amazing to me in Denver. And again, this is compared to this time last year. And that's a 10% increase. Sherrills Ford, $377,000. That's a almost 6% increase. And Huntersville is $540,000, an almost 19% increase from this time last year. It's amazing to me. So anyways, I hope you guys find this very helpful and informational. You have any questions for Matt or myself, even if it's just you're trying to do some research and stuff like that for now or in the future, just let us know. But until next month, we're here for you. Talk to you later.
Bye. Guys.